Have you ever reviewed your trading history and thought, who the heck opened these trades? Did a caffeinated squirrel hijack my account? I've been there, staring at my screen, trying to make sense of what feels like the aftermath of a wild night out. But instead of finding a clown shoe in the hallway, it's a string of baffling trades. The thing is, our brains love to play tricks on us. Sneaky little cognitive biases creep in, silently sabotaging our trading decisions like invisible gremlins eating away at our profits. But once you can spot these mental saboteurs, you can outsmart them. And in this video, we'll expose these hidden trading psychological traps and arm you with the strategies to take back control of your trading. Ready to fight back? Let's dive in. Number 1. Anchoring bias. Anchoring bias is a psychological trap where traders fixate on an initial price or number, even if it has no relevance to the current market conditions. This bias often leads to poor decision-making, as traders base their expectations on outdated or irrelevant information, rather than analyzing the present situation objectively. What anchoring bias looks like in trading. Imagine you're trading the Euro-USD pair. A week ago, the pair was trading at 1,1200, but due to unexpected economic data, it's now at 1,800. You think to yourself, it was at 1,1200 just a few weeks ago. This must be a bargain. It's bound to recover. So you go long on Euro-USD, expecting it to return to 1,1200. However, your decision isn't based on current market conditions, like weakening European economic data or strengthening US dollar sentiment. Instead, you're anchored to the previous high of 1,1200, which no longer reflects the market's reality. As a result, the price continues to fall to 1,700, and you're left holding a losing position, all because you let an irrelevant past price dictate your expectations. Here is another example I am certain most of us can relate to. In 2018, Bitcoin dropped from its all-time high of $20,000 to under $4,000 within a year. Many held onto their positions, convinced it would quickly recover to $20,000 because they were anchored to that peak price. However, Bitcoin didn't revisit $20,000 until late 2020, nearly 2 years later. Traders who anchored to the $20,000 level missed other opportunities to reallocate their capital or trade the smaller up and down swings during that period. Instead, they remained stuck, waiting for a recovery that didn't happen on their timeline. Anchoring bias leads to unnecessary risks, as traders hold on to losing positions far longer than they should, hoping for a rebound. So, how can you avoid anchoring bias as a trader? To avoid falling into this mental trap, focus on current market conditions by analyzing fundamentals, technical indicators, and sentiment rather than relying on outdated price levels. Treat past highs or lows as historical data, not guaranteed targets, and set realistic price goals using tools like support and resistance. And always let risk management guide your trades, using stop losses, and take profits to stay objective, and avoid emotional attachment to past prices. When you break free from anchoring bias, you'll make more rational, informed trades and avoid the traps that keep so many traders stuck in losing positions. Number 2. Loss aversion. This is one of the most deeply rooted biases in human psychology, and in trading, it can be especially destructive. At its core, it's the tendency to feel the pain of a loss far more intensely than the pleasure of an equivalent gain. Psychologists suggest that losing $100 feels roughly twice as painful as the joy of gaining $100. In trading, this emotional imbalance can cause paralysis, poor decision-making, and ironically greater losses over time. How loss aversion affects traders. Scenario 1. Holding onto losing trades too long. Imagine you bought Solana at $50, believing it would rise to $60. Instead, the market takes a turn, and Solana drops to $45, then $40, then $35. You're watching the red numbers pile up, but instead of cutting your losses, you tell yourself, the market will bounce back. I just need to wait. I'll sell when it gets back to $50. I can't afford to lose. What's really happening? Loss aversion is convincing you that locking in the loss at $35 is too painful to bear. But the truth is, the markets don't care about your emotions or your entry price, and refusing to cut your losses, you risk the price dropping further to $25, $20, or worse, turning a manageable loss into a catastrophic one. Scenario 2. Selling winning trades too early. Loss aversion doesn't just impact your losing trades. It can also cause you to prematurely exit winning trades to lock in profits. Suppose you bought Ethereum at $1,800, and now it's at $2,200. A voice in your head might say, "Sell now before the market turns against you." Instead of letting your profits run and maximizing your gains, you sell out of fear of a potential loss, leaving money on the table. Ironically, this is the opposite of the golden trading rule: cut your losses, let your winners run. Real-life example. The 2022 bear market. The 2022 crypto bear market was a masterclass in how loss aversion wreaks havoc on traders. Many retail investors bought coins like Bitcoin, Ethereum, and Cardano near their all-time highs during the 2021 bull run. As prices began to drop, some traders refused to sell, convinced that the market would recover soon. Investors who bought Bitcoin at $60,000 watched it decline to $30,000, then $20,000. Many held on, hoping for a rebound, while others doubled down, averaging down their entry price without proper risk management. For some, this decision led to devastating portfolio losses as Bitcoin bottomed out near $16,000. This shows how loss aversion can cloud judgment and lead to poor decision-making, particularly in volatile markets like crypto. Why loss aversion happens? Loss aversion is a product of our evolutionary past. In ancient times, survival often depended on avoiding risks, like predators or dangerous terrain. While this instinct might have helped our ancestors stay alive, it's counterproductive in the world of trading, where risk is inherent and losses are inevitable. In trading, this bias causes two common pitfalls. Traders emotionally anchor themselves to their entry price, feeling like they've failed if they sell for less. Secondly, many hold on to losing positions because selling confirms their mistake, and they want to avoid the regret of making a bad decision. How do you overcome loss aversion? Losing money is an inevitable part of trading. Even the most seasoned professionals experience losses. The key is to view those losses not as failures but as opportunities to learn, like paying tuition for an education in the markets. Each loss holds a lesson, whether it's about timing, strategy, or managing emotions. To protect yourself and improve over time, start by setting clear, unwavering rules for your trades. Using tools like automatic stop-loss orders to cap potential losses and stick to a consistent risk-reward ratio to ensure that every trade has a calculated potential for profit versus loss. These rules act as guardrails, preventing emotional decisions that could spiral into bigger problems. Another powerful habit is keeping a trading journal. Document every trade, your reasoning, the outcome, and your emotional state at the time. Over time, this journal becomes a treasure trove of insights, allowing you to identify patterns, correct mistakes, and refine your strategies. Most importantly, remember that your value isn't tied to your wins or losses. Trading is just one part of your life, not your entire identity. Don't let a few bad trades overshadow your progress. Instead, treat every step, good or bad, as part of your journey to becoming a better trader. 3. The sunk cost fallacy. The sunk cost fallacy is one of the most common psychological traps we traders fall into. It's the mindset that says, "I've already put so much time or money into this trade, I can't let it go now." This thinking convinces you to hold on to a losing trade, hoping that the market will eventually turn in your favor. But the harsh truth is, the market doesn't care how much you've already invested, and clinging to a bad trade won't magically make it profitable. What the sunk cost fallacy looks like in trading. Imagine you're trading the pound-dollar pair. You've analyzed the market and decided to go long, believing the pound will strengthen against the dollar. You enter the trade at 1,000, with a stop loss at 950 and a target at 1,100. At first, the trade moves slightly in your favor, climbing to 110.20. But then, unexpected news causes the dollar to strengthen, and the price starts falling. It quickly approaches your stop loss at 950. Here's where the sunk cost fallacy kicks in. Instead of accepting the loss and sticking to your stop loss level, you think, I've already invested time and money in this trade. I can't let it go now. What if the market reverses right after I close the trade? I'll lose money for nothing. So you remove your stop loss and hold on. The price drops to 1,900, and now you're in an even deeper hole. You tell yourself, I'll wait for a bounce to recover my losses, but the market keeps falling, and by the time you decide to close the trade, your losses are far greater than they would have been if you had followed your original plan. The sunk cost fallacy is dangerous because it amplifies losses by convincing you to hold on to bad trades, hoping they'll turn around, which clouds your judgment and leads to emotional trading decisions. This fixation on losing trades also distracts you from better opportunities, tying up both your capital and mental energy. So, how to avoid the sunk cost fallacy? The secret is to set a stop loss for every trade and stick to it. Stop loss is there to protect you from excessive losses. Treat each trade as independent, focus on the bigger picture, and don't let emotions like regret or hope cloud your judgment. Losses are learning opportunities, so use them to refine your strategy while following a risk management plan to safeguard your account. If a trade is going against you and your analysis no longer supports it, don't hesitate. Exit the trade. Cutting your losses early is one of the most important habits a trader can develop. In trading, hope is not a strategy. The sooner you accept that losses are part of the game and learn to cut them early, the faster you'll grow as a trader. Every losing trade is just one of many. It doesn't define you, and it doesn't determine your success. Your ability to learn, adapt, and move on is what matters the most. Number 4. The bandwagon effect. You're scrolling through Twitter or Reddit, and you see post after post about a particular cryptocurrency. Everyone is hyped, calling it the next big thing. The price is already climbing, and you start to feel it, the itch to jump in before you miss out. You don't analyze the charts, check the fundamentals, or review your trading strategy. Instead, you hit buy because everyone else seems to be making money, and for a while, it might even work. But often, by the time you join the party, the hype is already priced in, and you're left holding the bag when the market turns. Real-life example: the GameStop frenzy. Let's take the GameStop saga as an example. In early 2021, GameStop's stock price skyrocketed because of a social media-driven frenzy fueled by Reddit's Wall Street Bets community. It started with a group of retail traders trying to push back against institutional short sellers, but it quickly spiraled into a global phenomenon. At one point, the stock went from under $20 to over $300 per share in just weeks. The headlines were everywhere, and social media exploded with stories of people making small fortunes. It was hard not to feel like you were missing out. But here's the problem. Many traders jumped in late, buying GameStop when the hype was at its peak. When the price inevitably crashed, those latecomers suffered massive losses. They had followed the crowd without understanding the risks, chasing profits instead of sticking to a plan. Why the bandwagon effect is so dangerous. Joining a popular trend often means entering a trade late at inflated prices, increasing your risk of loss. This reactive approach, driven by hype and fear of missing out, contradicts the disciplined, proactive strategies employed by successful traders. To avoid being a victim of the bandwagon effect, stick to a solid trading plan. Do your own research and only take trades and buy into financial investments that align with your strategy, no matter how hyped they are. Resist FOMO. Focus on spotting early opportunities and ignore social media noise to make independent, informed decisions. Trading isn't a popularity contest. Just because everyone else is jumping into a stock, crypto, or forex pair doesn't mean it's the right move for you. If anything, by the time everyone's talking about it, the opportunity has likely passed. Number 5. Overconfidence bias. Overconfidence bias is one of the sneakiest psychological traps in trading, affecting even the most seasoned professionals. You and I have been there. It's when you overestimate your abilities, believing you're better at trading than you actually are. And while confidence is important, overconfidence can lead to reckless decisions that derail even the best trading strategies. Let's take the crypto 2021 bull run. Many traders entered the market when Bitcoin was surging to an all-time high of $69,000. An overconfident friend of mine, buoyed by quick profits, decided to leverage trade at 20x, betting that Bitcoin would break $70,000. He ignored market signals indicating potential exhaustion in the rally, and when Bitcoin suddenly dropped to $60,000, his leveraged position was liquidated, wiping out not just his gains, but a significant portion of his trading capital. This is overconfidence bias in action, and it is happening right now to many with the current Bitcoin rally. Many are mistaking the streak of good trades for infallibility and taking on unnecessary risk. It's easy to get carried away after a winning streak, but don't let it go to your head. You really look at each trade. Was it pure luck, or did your skill actually make the difference? Stick to your plan, manage your risks, and take a short break to clear your head. This will help you stay grounded and avoid those costly mistakes that overconfidence can bring. Every trader, no matter how experienced, is susceptible to overconfidence. Markets are unpredictable, and no streak, good or bad, lasts forever. When you stay disciplined and humble, you'll avoid the pitfalls of overconfidence and keep your trading journey on the right track. These sneaky mental traps can seriously mess with your trading decisions. The silver lining: just being aware of them is a huge step toward beating them. Start spotting these biases in your own trades, and you'll already be way ahead of most traders out there. Trading may seem glamorous, but it's a tough psychological battle. In this recommended video, I revealed 10 harsh truths about trading psychology that most only learn after years of costly mistakes. Watch it. You will be glad you did. If this hit home for you, don't forget to like, comment, and subscribe. Thanks for watching.